So I am a recovering investment advisor. And I say recovering because it took me a while to see behind the curtain, just like in The Wizard of Oz. When The Wizard of Oz was exposed, the guy said, pay no attention to the man behind the curtain. Well, Wall Street has a curtain and most people have not seen behind it. I've had over 1,200 one-on-one phone calls with high net worth investors, average net worth over 2 million. Most people have no idea that these kind of secrets are actually, these dark things are actually going on in Wall Street. And so it's really interesting to me that the SEC, which is the Securities Exchange Commission, that they look for fraudsters like Bernie Madoff, but they don't look for the things in plain sight that are actually causing people incredible harm. So I'm going to pull back the curtain for you in this video, and I hope that you really enjoy it because I want to really expose some stuff that's happened in Wall Street, kind of let this be a tell-all episode. So stick around, there's going to be a good quote at the end. I think you're really going to enjoy this. All right, so as we get started here, just a disclaimer, I am not your financial advisor. Even though I was a financial advisor, I'm not your financial advisor. Isn't that ironic? But the first thing I want to say is that Wall Street does not have your best interest in mind. Now, that might not be a surprise to you, but I'm going to get to you and show you proof of why that is the case and some things that you didn't know. There's a book that came out by Tony Robbins called Money Master the Game, and it basically talks about Wall Street mutual funds, saying that their average fee is 1.2%, and you'll see that commonly, 1.2 to 1.4%. It's pretty common. But when you have all these hidden fees, literally these fees that they legally don't have to disclose, figure out how that works, right? Things like cash drag fee, administrative fee, expense fee, just these BS fees, they can call them whatever they want, but they're basically in this mutual fund. So the mutual fund actually ends up having about a 3.2% expense on average, which is way higher than 1.2%, right? And then if you have a financial advisor, let's say you have somebody like at a big Wall Street firm, commonly their fee just for managing any of your stuff is a global 2% fee on the top. So that's 5.2 or 5.4%, somewhere in that range, which is almost all of your returns. Typically stocks on average, when you count the up and down years, it's around 6 to 7%. So literally taking all of your money, almost all of your money. And this is something nobody ever talks about. We have trillions of dollars, something like $3 trillion or more in retirement accounts in the US. We've bought this hook, line, and sinker. This is the way to save, but it's not really giving the returns that we really think that we're getting. So it's interesting how that is. And now the other thing that is interesting in Wall Street is that they basically say that as an investment advisor, you have to put people into suitable investments. How does that sound? I have this suitable investment for you. It's going to give you a mediocre return and you're just going to be ho-hum with it for the next 20 years. But it's suitable for you, right? Which is crazy. Like, I mean, would you like a suitable spouse? Would you like a suitable car? Would you like to go on a suitable vacation? I mean, that sounds like the most boring, terrible thing ever. But again, Wall Street is set up just to kind of get you into a box saying, this is where you are, this is where you fit. It's good enough for you and to get you kind of where you want to go. So Wall Street is really set up to get you to invest in paper assets and make you think that they are real assets. And I'm going to explain what I mean by this, is that when you own a share of a company, it is a paper basically that says, of course it's digital paper now, but it was when it was created, it was a, years ago, the history was a paper that said you own a certain share, a certain percentage ownership of this company. Now the advantage of paper assets is that they can be traded very quickly. You can know immediately what they're worth all the time. Real assets typically are very different than that. You don't always know what something's worth. Like if I am in this house and I want to sell it, I can't just immediately go on an exchange and sell it in 5 minutes or less, right? I can't sell it instantly. It might take months to sell it. So real assets, there's less liquidity, which is a disadvantage, but it's actually owning something that's actually real versus owning something that is just a paper, right? So those things are very different. Now the way Wall Street does this, and this is really shady, is that they'll have shares of a product. Now, one way I like this is I like to own physical gold. So I've got my gold bar right here, and I like to own, shares of gold, or actually physical gold. But if I were to buy an ETF that had gold, they would buy 1 bar of gold, and they would sell 10 or 20 or 30 or however many shares of this bar of gold. Now, they're selling the paper, right? There is a real asset, but they're selling paper. If there's a run on gold and everybody wants their gold, but they've sold all these shares. They only have 1 bar of gold for every 10 or 20 people that actually own these shares. Who gets the gold, right? And that's a real issue. And so Wall Street, again, it's a sleight of hand. As long as everybody doesn't want their stuff at the same time, we're okay. So that's again by owning real assets like gold. We've got real estate back here. They're actually physical real assets. There is something that happened, that you've probably heard of in 1929, there was the great crash close to 100 years ago. Stocks were just super, super hot. Everybody loved stocks. They said, why in the world would you not do stocks? Then stocks crashed and they came down so far for so long, it took 25 years for things to get back to where they were. I want to put this in perspective for you, right? So if the Dow Jones right now is 33,000 or 36,000, somewhere in that range, I think the high was around 36,000. If it took until 2047 for it to get back to the same level, you just think about that for a minute. So if it crashed from the current level, you had all your retirement in there, and it took that long to get back to where we are now. That would be just absolutely terrible. So there was a decade in there or more where people, were talking about stocks and they would say, well, why in the world would you ever invest in stocks, right? Because they're terrible. Look what they've done. It's speculative. It's this and that. It's awful. So again, there are things that are paper assets. There's also something called counterparty risk. Counterparty risk, I mentioned it a little bit here with the gold, but let's say anybody who's involved in this paper transaction. So again, somebody sells you a share. Well, what happens if the issuing bank or the issuing broker that had that, has a financial trouble? Or let's see what happens when the company itself has financial trouble. Or let's see what happens when maybe there's an insurance company that's not able to pay. So all of these are kind of things along the way that can cause a counterparty risk. That basically somebody owes a certain amount on that asset or owes the ability to issue whatever that the stock or whatever the security is, though they can fail. So it can cause major issues. So it's interesting to me that Wall Street has spent billions of dollars to convince you that paper assets are actually real and they're safe and they're traditional. But again, it's because they spend billions of dollars that we all believe it. But I really think there's going to be a shift back into real assets, such as real estate, such as metals, such as other things, even things maybe that are a little bit outside of the norm. People are going to start buying more commodities and other things, because I think that there will come a point where how financial and the securitization, which just means they put things together as investment vehicles, is not going to perform the way that they want. So we're going to talk now about the alignment of interest between Wall Street and investors. Okay, so the second thing is that Wall Street fees create a misalignment of interest. Now what I mean by this is that when they charge a fee for managing your money, a lot of times their incentive to sell you certain products. This is like us like if I go to a used car lot and I talk to Fast Eddie, right? You know Fast Eddie. He's really excited to see you in that nice 1972 Buick that you have no interest in, but right? He really wants to get you in that. Why? Because he's incentivized to sell you a car. Wall Street is incentivized to sell you securities, and not just securities, they're incentivized to sell you their types of funds, their types of mutual funds. If you do have a money person, it's interesting, let's say it's with a certain Wall Street firm, a lot of times they have their own funds that they will put you into that they'll make more money. They're actually incentivized to do that. And the interesting thing looking back on being an investment advisor and what I would observe kind of in my colleagues is that there was a big emphasis not necessarily on investment management, right? It was more about people management. It was more about networking. And if things do go down, it was more about trying to get people not to sell. Well, why is that? I mean, I think there's some value to say, yeah, if things crash 50%, oh, you shouldn't sell because things will go right back up, or hey, this is a buying opportunity. But you can see that the person who's giving this advice is incentivized to get you to simply buy and hold and not to sell, right? Because their fees are based on assets under management. There's kind of this ego thing of, well, how much money are you managing? How much assets under management? Right? And it's not about the person that's actually on the other side of that. It's just about how much are you actually doing. So, even if, somebody is saying something is a great investment, I try to look and see what is this person actually doing. And most of these people that are managing people's money, they don't have any money there's no skin in the game. There's actually a study that came out that said that over 50% of the 15,000 mutual funds that were out there, 50% of the managers didn't have a single dollar in the fund at all. And of those that had money in, it could have been very minimal, right? So people are selling stuff that they're not actually but they don't actually believe in themselves, which is really terrible. So, one thing, we'll kind of mention this before about alignment of interest, is that if there is a skin in the game, if there is a way that someone is incentivized, it's called performance-based investing. It exists in hedge funds, it exists in what we do, which is multifamily syndication, where the sponsor is incentivized to not only put money into the deal, but as well as how the deal performs is really how they get paid. I think it's a better way to do it. I'm going to get into that in a minute. But again, financial management, they say it's like brain surgery, right? You have to trust the experts. And my background, I worked in medical sales for a while as well. And there was kind of this expert thing. And I get it. If you're sick and you have a brain tumor, you want a brain surgeon working on it. For financial management, I would say that's absolutely opposite, and it's just marketing by Wall Street. So I'm going to talk to you about another way you can look at investing that'll help you. All right, so there is another way to invest. There's a way that makes much more sense than following Wall Street blindly into a hole, right? And what it is, it's looking for aligned interests. And what I mean by that is what I was talking about before, is just that the Wall Street manager managing your money has no skin in the game. Right? The deals that we do, and we're not the only group, not the only type of asset that does this, but we typically, if we raise $10 million for a multifamily deal, kind of like this one behind me here, we're putting in typically 5 to 10% of the amount. So that's $500,000 to $1 million of our own money from the sponsor team into that deal. So we're very interested to make sure that that property actually performs, right? It's a very simple thing. But again, it's something that Wall Street, it's typically not disclosed, it's not talked about. It's almost rude if you ask, hey, is this manager invested in this? It's stuff, they don't even have that information, right? So it's something that having aligned interest is really, really important. It's like if you have a business partner and yet they don't have anything invested in it, they have nothing to lose, and you're the entire amount of money invested in it. It doesn't make you feel really good. The person managing the business doesn't have any of their own money in, right? So if you can align interests, it's a much, much better way of doing it. And this typically exists a lot more in the real asset world rather than the paper asset world, right? So that's really one of the dark secrets, is that there's such a misalignment of interest. There's such a way that Wall Street has to cheat people. Not, all of a sudden at front like Bernie Madoff, which does happen as well, but it's this kind of death by 1,000 paper cuts and fees and hidden stuff that's just really, really inappropriate. I feel it's really kind of, below the belt, just really stuff that should not be done, but it is done very often. So look for real assets. Obviously, the negative side is it's negative and positive, is it's less liquid, which in a panic is actually a good thing because it's harder to sell. And so, the prices tend to be a little more a little less volatile, I should say. But the plus side is that obviously you get to have a much more stable asset. So if you can minimize your counterparty risk, you can have less paper assets and more real financial assets, especially these days when debt is cheap. If you can get businesses, or you can get real estate or other things that are productive, owning productive assets will really make you much better off. So anyway, the biggest thing is to start diversifying, start small. This is a plan I give to a lot of people that, I've had, many of these calls, like I mentioned, but I remember one call with a doctor who was, net worth of $5 million, and he had never invested in anything but stocks and bonds. So for that person, and maybe for you as well, it's to get started, right? To get, a small amount of money, maybe 75 or 100,000, which for some people is a lot of money, right? But if for somebody who's a $5 million net worth, that's less than, it's a very small percentage of their net worth. So they invest in one deal, maybe a couple of deals, and then they'll learn, right? They'll pay attention because they're involved, and hopefully they'll get some idea of, oh wow, this really actually works. This is a way that I can actually grow my wealth, and maybe I can retire from my job, or maybe I can go and be able to kind of live life how I want it. So, so go ahead and do that. If you're interested in joining our investment club, there's a link below. You can check that out, and you can check out some of our deals, like this one behind me that we do, that we're trying to get great returns for investors. I want to read this quote for you here. It's by my friend Warren Buffett, who's not really my friend. I just admire him a lot, so I call him my friend. But it says, Wall Street is the only place that people ride in a Rolls Royce to get advice from those who take the subway. So keep in mind, when you talk to a financial advisor or you talk to a used car salesman, just keep in mind who you're talking to and what their incentives actually are, right? If you're interested in how to become more wealthy and how millionaires are made, this is kind of my story and what I've seen of how millionaires are made. You can check out this video up here. It's a great video. And then I want to see in the comments below, what are you invested in that has taken you out of Wall Street and into Main Street? So stick that in the comments. Love to hear from you. Thanks for taking the time to educate yourself. I look forward to seeing you on the next video.